Hello, class. Welcome to this chapter 2 lecture. We made it through chapter 1 all right. Chapter 2 here is probably one of the most important chapters to understand because we're going to start talking about recording transactions, analyzing and recording transactions, and that's what we're going to be doing for the rest of the semester. Kind of get some stuff set up for you here. All right, let me share my screen and we'll get started here. All right, chapter 2, the accounting information system. Okay, for this lecture, you're going to need your outline handy, and you would also want to have the chapter 2 slide handout ready, because as we're going through some of these slides, I think it'll help you, it'll assist you if you were to write down some of the stuff we're talking about as we go through there, especially when it comes to analyzing the transactions. Okay, so what we're going to do in this chapter, first, we're going to learn some characteristics of accounting information that is put out by the FASB. If you recall from our chapter 1 lecture and homework and stuff, the FASB is the Financial Accounting Standards Boards. They're the one that sets the rules for accounting, and the rules are called US GAAP, the generally accepted accounting principles. Okay, so they've also put out some characteristics, assumptions, and principles that we're going to use throughout the semester when we're going through and we're analyzing these transactions and we're deciding how we should record them. Okay, we're going to expand the accounting equation a little bit. Just to review, the accounting equation with assets equals liability plus stockholders' equity. Well, there's some stuff that goes into stockholders' equity through retained earnings, such as revenues, expenses, and dividends. Okay, so we're just going to expand that equation so that way, hopefully it'll make more sense on how revenues, expenses, and dividends affect that accounting equation. Then we're going to analyze some transactions, and then we are going to learn to use a double entry accounting system where we're going to do things like debits and credits. Okay, so this is something you're going to hear me say all semester through these videos is what are you going to debit, what are you going to credit? That is when we're doing journal entries. And then we're going to go through the accounting cycle, okay, which is how we record things and get them to the final point where we can make those financial statements that we learned in chapter 1, prepare the journal entries, and then we're going to post them to a general ledger and then prepare a trial balance. All right, so I'm just going to skip over that one. Here is what the generally accepted principles, the conceptual framework is what it's called, okay? So we have some qualitative characteristics, we have some assumptions, and we have some principles. We need to make sure we're following these and kind of understanding these as we're going through. So our qualitative characteristics, there's 2 fundamental qualities of accounting information, okay, according to FASB. Whenever we're recording something or we're reporting on something through a financial statement, first we need to make sure that the information is relevant. Okay. For information to be relevant, it has to serve some type of purpose for the people that are using this financial information. Okay. So how can it be relevant? Well, it can be relevant if it predicts future events. Okay, so if you're looking at your financial statements, you can see how we can look at 4 years in a row of financial statements, and then based on that, we can kind of predict what's going to happen in the future. So it has to have that predictive value. It also has to have confirmatory value. Okay, so we should be able to look at financial information and see after we predicted it, how accurate our predictions was, if we confirm our predictions. And finally, for it to be relevant, it has to be material. Okay, material is one of the hardest things to kind of understand in accounting because it's all based off of professional judgment here. What materiality means is if this information was omitted and we did not tell you about it, would it affect the decision that the users were making. Okay, it's usually based on some dollar amount. Okay, so for example, if a company was doing multi-billion dollars in sales, okay, and you get and you see that they forgot to record a $1, box of Staples purchase. Is that $1 that they're not telling you about that they accidentally left out? Is that material to the company when they're doing $1 billion worth in sales? Is that $1 really going to influence your decision when you're thinking about investing in this company if you did not know about it? No, so that would be considered immaterial. On the other hand, if they were going to invest $500,000 into a new piece of equipment, okay, $500,000 is a pretty large amount, even with a multi-billion-dollar company. That is probably something the users of this information, they would like to know about. So that would be a material item. Okay, put those three together. If it's predictive, if it predict what's going to happen in the future, and confirm what our predictions were, and as long as it's material, that makes the accounting information relevant to the users. The second fundamental characteristic is faithful representation. Okay, this just means that we need to present information that is accurate. Okay, has to be complete. Okay, contains everything possible for the users to make the best decisions. It has to be neutral. And neutral means unbiased. Okay. So don't want to try to put things in the best light for your company if you're an accountant for that company. Okay. Speaker. Oh, these video issues are really going to drive me crazy. Video and audio issues. I hope you can still hear me. Let me make sure my microphone. Okay, still showing some sound up there. So that's a good thing. Let me see what speaker it's got me on here before we go on. So I'm on the microphone here, so hopefully I'm speaking loud enough that you're able to understand. Okay, so it has to be neutral, unbiased, and finally free from error. And it doesn't mean that everything is recorded perfectly. It means that basically means we're following the rules. Okay, it's accurate. It's done the way GAAP says it wants to be done. Okay, so those are the fundamental characteristics. They always need to be followed. Okay, it's the first thing you're going to look at when you're going to record anything. When we're going to go to report anything, is making sure that the information is both relevant and it is faithfully representative. Now, there's some enhancing qualities. The enhancing qualities are secondary to the fundamental qualities. When we want to do the enhancing quality, this makes the information given that is relevant and is faithfully representative. This just makes this information better. Okay. The first enhancing quality that information should be is comparability. All right. So that way, we know things are done the same way. So we are able to compare 1 year to the next. Okay. Another way to think of this is it's being done consistent. It's being done in the same manner all the time. You can see as you'll see when we get moving on and we get into maybe some operating assets, there are multiple different ways to calculate that depreciation expense that we kind of touched on a little bit in chapter 1. All right. If you're using one method for some equipment and another method for another equipment, that's not very useful to the users of the financial statements. Now, while it might be relevant, it might be faithfully representative there, you can't compare it between the two things. Okay. The goal of comparability is just to achieve by consistency, always doing things in the right way. The second is verifiability. So the information that we put out, it should be able to be verified by an independent third-party source. And most often that is done through auditing. You hire an outside accounting company to come in and audit your books to make sure that it is, that you can verify it. Timeliness. Okay. Timeliness just means that information is available to the users when they need it. Okay, you need to get your financial statements out on time, usually on a regular basis. If I am looking to invest in a company, say in February of 2000, and the latest financial information I have from them is from February of 1998, 2 years ago, that information is probably not very useful to me. So we want to, as accountants, we want to get that information out as fast as possible. So that way the users have the latest information and they're able to make the best decisions. And understandability, not everyone is going to understand accounting information, but it needs to be presented in a way that someone with reasonable knowledge and have studied accounting just a little bit, they should be able to understand what the financial statements and the notes that accompany them are saying. Okay, so those are our enhancing characteristics. There are some, all of these, whether it is the fundamental qualitative characteristics or the enhancing characteristics, they're all subject to what we call a cost constraint. Another way to think of this is doing a cost benefit analysis. Okay, is the benefit we are providing by making sure we're giving this all this information, okay, that the benefit has to be greater than the cost associated with it. And there is a high cost when it comes to tracking every bit of financial information. Okay, and that kind of goes back to that materiality thing. Okay, if it's immaterial, we don't want to sink a lot of cost into it in order to make sure that users have that, because it's not going to affect the decision anyway. There's no benefit in providing some information that is immaterial. If the cost exceeds the benefit, then the information is considered not useful. So, yeah. So as we go through this chapter 2, now we're making sure that things are following the quality characteristics that are relevant and essentially representative. We're enhancing them where we can, as long as it fits within that cost constraint, and our benefits are doing good. There are some assumptions that are being made here while we're presenting this information. Okay, the first is the economic entity assumption. This just lets us assume or know that a business or corporation is separate from its owners. Okay, so if an owner of a company wants to go out and buy a personal truck, they don't use business funds for that. Okay, they can take it out of their business and put it into their own personal account if they're a sole proprietorship, but they don't want to record that into their business journal. They don't want to record and report about personal purchases that the owner makes into the business records. Okay, we want to make sure that we keep those separate. What the owner does and what the business does are two separate things. Second is our going concern assumption. Here, we're going to assume that the business, the corporation, has indefinite life, and it's not going out of business anytime soon, and it's going to last forever. The way you're going to hear this used a lot of times, maybe, is if a business is, if it's about to go under or about to go bankrupt, it'll be listed as having a going concern. Okay. When Walmart was going through its Chapter 11 bankruptcy, Kmart was going through its Chapter 11 bankruptcy a few years ago. If you were listening to Investors in Analysis, they would say Kmart has a big going concern. What it means is there's a chance that Kmart may not be around. We assume that it has indefinite life, but that is always not the case. Next is our time period assumption. This is assumed that we can take what is going on with the corporation and divide it into chunks of time and then give reports on that period of time, which is what most businesses do, whether that time be monthly, quarterly, semi-annually, annually. Most of them use all of those. We can break it down. And then finally is the monetary unit assumption. That means that everything that we're going to report about here in accounting is going to be in dollar terms. Okay, it has to be based in money. If it does not have a dollar amount or we cannot put a value to it, we don't record what's going on here. Okay, we don't need to report about it. So for example, if HR hires a new employee that's going to start in 2 months, Is that important to the accountant? Not really. It's important to the business because it's bringing it in. But at that point in time, when HR hires it, there is no value placed on it. Not until that employee starts working, and then there's value in the labor, and then we need to create an expense when we pay that employee. That's what creates the value. So we're only going to report things we can put a dollar amount on. When it comes to measuring and recording stuff too, we also have 4 basic principles. Okay. The first principle is the historic cost principles. Okay. It requires that our activities be recorded at what they originally cost. This is one that's kind of a big difference between what is going on with US GAAP and what is going on with the IFRS, International Financial Reporting Standards. IFRS allows a lot of fair market value reporting. Okay. In the US, we're always going to report stuff at the historical cost. So if we went out and we bought a piece of equipment and we paid $200,000 for it, it is always going to be listed on our books. We're always going to report that at $200,000. Okay, we're going to take depreciation off of it, as you will learn in chapter 7. So it's going to increase the book value, but it's always going to be $200,000 less whatever we've done with depreciation. The difference is in fair market value reporting, if that machine were to go up and down in value, then we would change what it's on our books at. We wouldn't depreciate it. We would just always keep it listed there at its fair market value. The US GAAP requires that everything be reported at its historical cost. Another way to think of it is original cost. Our second principle is the revenue recognition principle. That's what we're going to use to determine when revenue is recorded and reported. The simple revenue recognition principle is that we do not recognize revenue until service is performed or goods are delivered. Once that happens, then we have revenue. The expense recognition principle requires that whenever we have any kind of expenses, which are the normal course of doing business, it needs to be recorded in the same period that the revenue was generated. Okay. When we start talking about contingent liabilities, that stuff, I believe that is maybe chapter 8. Okay, that's where this expense recognition principle is going to come in, because there's bad debt. Some people are not going to pay. So we don't know that to the future, but to match this principle, we need to record stuff in the same period that we made the sales. We need to record an estimate on how many people are not going to pay. And finally is our conservatism principle. US GAAP is a very conservative set of rules. It means we don't want to overstate our assets or income when we prepare financial statements. Okay, so that's why the way to think of this is we wait as long as possible to record revenues. Okay, we want to make sure we be 100% accurate that these revenues are coming in before we record them. Okay, but on the other hand, expenses, as soon as there's even a little hint that there could be an expense, we want to get that recorded. Okay, and that way we make sure that we are not overstating our income or how much assets we have. Okay, because we're always delaying the revenue and kind of rushing the expenses to make sure we get them reported. Okay, so which of the following basic assumptions would be most likely to require a person with 4 different businesses to have 4 different checking accounts? Okay, that is going to be the economic entity assumption. Okay, each business is separate from itself. Okay, when I explained this, I talked about it being separate from its owners. But yes, if one person owns 2 different businesses, they do not want to put their funds together. Okay, if they can be separated, you have one business operates alone by itself, has its own checking account, has its own set of books, all that stuff. And the second business has its own checking account, has its own set of books, and we do not intermingle them. Okay, I'm not going to go through this slide here, applying a conceptual framework, but I highly suggest you look through it, kind of get an idea how these are written out. Okay, so you can identify which one they're talking about, and then it gives the answer on the next slide. And I believe when we start doing chapter 2, handout 1, there's quite a few questions. We can practice this more on your own. Okay, and get used to identifying these principles and assumptions and the qualitative characteristics and so on. Yeah. So now we got all our assumptions and all our principles down. We're going to start going through the accounting cycle. Okay. In the accounting cycle, the first thing we're going to do is we're going to analyze the transaction. This is going next. What we're going to do, make sure it doesn't talk about it here. Okay. When we analyze transactions, what we're basically looking at, this is where we're going to identify and kind of measure. We're going to look at the accounting equation and we're going to say first, for the monetary unit assumption, do we have an event that actually deals with some kind of dollar amount, some kind of value? If our answer is yes, we go on. If it doesn't deal with some kind of dollar amounts, what is it affecting? Okay. Is it affecting equity, liabilities, assets? How is it affecting that? Okay. And then we're going to just make sure that we keep in step with our accounting equation. After we analyze it, then we're going to put it into a journal. The journal is the first record of entry. We'll talk about here in a little bit. It's where we record every transaction on the date that they happen. After we do a journal, then we're going to post to a general ledger. General ledger is just basically all the accounts that a company has. Prepare a trial balance. Okay, and that's where we're going to stop in chapter 2. But then when we get into chapter 3, we're going to have to see, because of that revenue and expense recognition principle, getting stuff in the right period, we're going to need to make some adjustment to the accounts. Then we prepare our financial statements, and then we close the accounts. Okay. So our expanded accounting equation here, as we start to analyze transactions, you should know that this is your accounting equation right here. Assets equals liability plus stockholders' equity. Included in stockholders' equity is that contributed capital and retained earnings. Okay. But within retained earnings, if you think back to your retained earnings statement, it's your beginning balance plus income. So income is revenues minus expenses. So if we're calculating how it's going to affect stockholders' equity, revenue is going to increase equity, while expenses are going to decrease equity. Okay, and that is your net income component right there. And then dividends that are declared and paid, that is also going to decrease our equity. Okay. So as we're analyzing transactions, and we're making sure that our accounting equation stays in balance, it's important to remember that all revenues and expenses and dividends are part of that equity section in the accounting equation. Okay. So here we're going to do some transaction analysis. Okay, has your 3 steps here. It says write down the accounting equation. That's just for your helpfulness, so you're used to seeing that. This is what I was saying. We're going to identify the financial statements, analysis elements that are affected by the transaction. Is it an asset? Is it a liability? Is it equity? And then we need to determine the amount and whether those amounts increased or decreased. Okay. So if you have your chapter 2 slide handout here, we're going to go through those now. All right. So our first one here, this is an example. It's not on your sheet. Luigi purchases $3,000 computer from Worth Spy Electronics on credit with payment due in 60 days. So we need to look at this. We need to analyze it. We have a dollar amount, so we know it's going to be $3,000. Okay. But what is happening here? We are purchasing a computer. A computer, that's property, plant, and equipment. Okay, so we're getting some equipment. That is an asset. So our assets are going up. But it says it's going to be on credit. So when stuff comes on credit and we have to pay someone later, that is an account payable. An account payable is a liability. So our liability is also increasing. So as you see here, when we have assets equals liabilities plus stockholder equity, our assets are going up by 3,000 and our liabilities are going up by 3,000. Our accounting equation here stays in balance. All right. We're going to run through the chapter 2 slide handout. On March 1st, High-Tech sold 1,000 shares of common stock to several investors for cash of 12,000. The effect on this accounting equation is, first, our dollar amount we're dealing with here, we're dealing with $12,000. We sold some shares of common stock, which means to several investors for cash, which means the business is getting cash at this point in time. Cash is an asset. As you can see here, our assets are going up by $12,000. Common stock makes you an owner of the company. So when that $12,000 comes in, that is money by owners being put into the company. That is considered contributed capital. And contributed capital is a part of stockholders' equity. So here our accounting equation stays in balance because our assets increased and our stockholder equity increased. For number 2, this time we borrowed $3,000 from a bank. And we promised to pay the bank the amount borrowed plus some interest. Okay. So in this case, we borrowed money. So as a company, we received cash. Cash being an asset, our assets increase. Okay. But we promised to pay the amount borrowed back. So now we owe something. Something we owe is a liability. So our liabilities also increased by $3,000 because we have to pay that back at some time in the future. Okay, so here we can see our accounting equation stays in balance by increasing our assets and increasing our liabilities. Next, we purchase some office equipment, such as computers again, for $4,500 in cash. Okay. So here we have some more equipment coming in. Equipment is considered property, plant, and equipment. That is an asset. Okay. So our assets are going to go up by $4,500, but we paid cash for them. Cash is also an asset. In this case, we are paying cash, so that amount of cash is going down. Okay. So we keep our accounting equation in balance here, even though we're not on both sides. This is one where it happens only on one side. We have assets going up and assets decreasing, but it ends up balancing out and keeping that accounting equation in balance. All right, so now here we purchased a 6-month insurance policy for $1,200 cash. Okay, when we purchase an insurance policy, we purchase something in advance. Okay, that is normally an expense. That is going to be a prepaid expense. Okay. So in this case, we have prepaid insurance. Prepaid expenses are assets. So our assets are increasing by $1,200 and we pay for it in cash. Okay. Cash is also an asset. So cash is going down in this case. Assets going up by $1,200, assets going down by $1,200, evens itself out and keeps that accounting equation in balance. So here we purchased some office supplies for $6,500 and we agreed to pay later. Okay. Anytime we agree to pay later, that means we owe somebody. So we're going to have a liability formed. The supplies were assets. Okay, our amount was $6,500. We increased our supplies, our assets by $6,500, and we increased what we owed or our liabilities by $6,500. Next, we provided some services for cash. Okay, we provided advertising service for exchange in $8,800 in cash. Here we provided a service, and the service is done. The value we get for that service, that is what revenue is. Okay. So in this case, if we were using the expanded accounting equation, we would know that our revenues actually increase our stockholders' equity through retained earnings. Because that, income goes into retained earnings, so our equity is going up by the revenue amount. But we also got paid right away. We received cash. Cash is an asset, a current asset. So our assets increase. As you can see, we stay in balance by increasing both sides of our accounting equation here. The trick is transaction 7, we provided services on credit. Okay. So here it's kind of the same thing as before. We provided a service, the service is done. When we provide that service, the value that we receive or that we're owed, that becomes revenue. Revenue in that expanded accounting equation increases retained earnings, which is part of stockholders' equity. So our equity is increasing. But now they're promising to pay us later. Now people owe us money. So that is an accounts receivable. Meaning we're going to receive this money sometime in the future, which is also a current asset. So to balance out our equation here, we are raising our assets by $3,300. All right. Transaction 8, we receive cash in advance. So here somebody gave us money, the Metropolitan News gave us $9,000. Okay. And they said we were with that $9,000, we we're going to use it to do advertisements over the next 3 months. Okay. So we are going to increase our assets by $9,000 here because obviously the business received cash, and cash is an asset. But this is that one unique liability that does not end in payable. While we do owe something here, we don't owe money, but instead we owe some work. We need to provide a service. So we would term this as unearned revenue. And unearned revenue is a liability. So to keep our accounting equation intact, we increase our assets and we increase our liabilities. In chapter 9, when we pay off a liability. Okay, so on March 23rd, we paid $6,000 cash from the supplies previously purchased. So if you remember back to transaction 5, we increased our assets by $6,000 because we got supplies, and we increased our liabilities because now we owed $6,000. But now when we pay it off, our assets are going to decrease by $6,000, but it's not the supplies that are decreasing, it's our cash. Because now we're actually paying the cash, and our liabilities are going down. We no longer owe that money to anyone. Okay, so we can reduce the amount of that we owe to people by lowering our liability. And as you can see from our screen here, this keeps the accounting equation intact. Transaction 10, collection of a receivable. Okay, so remember in chapter 7, we did some services. So when we perform the services, we increased our revenue, right? And we also increased our assets, and that asset was called accounts receivable. But now they're paying us money. So in this case, our assets are going up because we are receiving cash, which is an asset. But our assets are also going down, the accounts receivable. They no longer owe us money. Okay. So we can reduce the amount that we have recorded for people that owe us money. Transaction 11 here, we paid some salaries. Salaries, we paid them $1,800. Okay. Salaries, that is a normal cost of doing business. We need to pay this. That is an expense. An expense affects net income. Then net income affects retained earnings. So in this case, we are going to lower our retained earnings in our equity section by $1,800. And we also paid out cash. So our cash is going down by $1,800. So as you can see here, we stay in balance by lowering the assets and lowering our stockholders' equity through retained earnings. Transaction 12, our payment of utilities. So we got a bill in for $5,200. It says we're going to pay that, the utilities, that is the normal cost of doing business again. That becomes an expense. Okay, an expense affects income, which again is in retained earnings. So our stockholders' equity is going down by $5,200, and we paid cash out. So our cash is going down by $5,200, and we stay in balance here. Payment of a dividend. I don't have this one on your slide handout, huh? Oh, I don't know why I missed this one, but anyway, dividends come out of retained earnings. Retained earnings is part of equity, so our equity is going down 500, and we made the payment. So that means our cash is going down by 500. Okay, just kind of to expand on this one a little bit. What if we didn't make the payment? What if we said we're going to pay dividends, but we're going to pay you later? Well, then our equity would decrease by $500, and now we would owe somebody something. We would have to pay them later. So that means our liabilities would increase by $500. They would both be on the right side of the equation when we have minus 500 for equity, plus 500 for liabilities. And again, that accounting equation would stay balanced out. So if you look at 1 through 13, and say we started with $0, okay? We went through and we took what we did in each transaction and we added them up. You would see that we finished to 29,100 in assets. Our liabilities that were created were 12,500. And then we had 16,600 total in our stockholders' equity, with 12,000 of it being contributed capital and 4,600 of it being in retained earnings. And we stayed completely balanced throughout the whole thing at 29,100. Our assets equal our stockholders' equity plus our liability. Okay. So I'm going to stop and I'm going to make a second lecture video on this. But after you watch this lecture video, I suggest the next thing you do instead of watching lecture 2 is going and working on chapter 2, handout 1. Because in the second video lecture video I'm going to make, we're going to start actually talking about journalizing those transactions. And those are good, and that's good information for handouts 2 and handout 3. Okay, so go work on chapter 2, handout 1, and try to get these principles and the qualitative characteristics and stuff down, and how to analyze a transaction before moving on to the journal entries. And it'll make your journal entries so much simpler if you're understanding how to analyze transactions. And I'll talk to you again soon.